first thing about construction risk is we don't do any of the construction in-house. And being an attorney, I want somebody to sue if something goes wrong. And the construction business, the margins, aren't as sexy as we like, and the risk is predominantly higher. So the first thing that we do to manage construction risk is we RFP the bids. So we'll go out and look at the whole market from a general contractor standpoint, and we're underwriting their execution risk, their track record, their insurance, how they source projects, et cetera. And then we oversee the construction more from a construction management role and don't take on the risk of executing and getting the subcontractors and dealing with all the mechanisms which people do, that are vertically integrated. They want to run the construction. We want to be in the investment business. We don't want to be in the construction business. Some of the things is par for the course in the sense of you can't control the uncontrollable, and this is not, there's nothing about this is guaranteed. So the risk reward ratio is the first thing you just have to accept, right? But when you invest in markets that are based around population migration growth and around corporate relocations, you might not know, in that exact, you want to execute and break ground in 9 months. Well, you might be wrong about that, but it's very hard to be wrong about the market on a longer term basis. So the first thing we do is manage the investor expectation of saying, this is not a fix and flip. So in a 2-year, 3-year, 4-year, because the way that we're structured, we're not rewarded for capital raising, meaning that we need to make money, break the preferred return, and get into the promote to make money. So we have an alignment of interest to be able to actually go make money because we make money with our clients. But with that said, there has to be a buffer of time, and you have to manage those expectations, and you shouldn't be in private equity if you're not prepared to wait for 5 years. So I can say, we think this is a 3 to 4 year time horizon, but the reality of it is you need to have the stomach as an investor to know this could take 5 or 6 years. And because sometimes you go in and you prime it, you buy. It's great examples right now. We have some of the best land located in the entire city of Austin and entire Austin MSA. Technically, a couple projects are a year and a half delayed from what we saw, but now the pent-up demand and the value creation has been so dramatic that we're crushing our pro formas. So we were wrong on the exact time, but we were fundamentally right on the markets that we invested in. So you have to create just a very transparent buffer that the timing just could vary. And we're not talking about varying for 10 years, but if you can't have the stomach to have an 18-month or a 2-year exit buffer, these deals you shouldn't do them. You should just buy an index fund.